Yes. How are you? Yes, I can't hear you. What's your email? Do you have the InVhestia Nini? Just share with you. I think you have to register before you come in. Sorry. So Teams. Finish the session. So we wanted to have the valuation as the foundation of this particular discussion, and then the rundown of the evaluate, and then we launch the session. Any questions, Dennis, Benjamin?
Okay, I don't think I have a question right now.
Yeah.
Because I went through the questions, or maybe just to ask. So you as the host will be asking one question, then we jump to the next person, or how are we going to do this?
So I wanted the questions to be open. So I ask, and then probably Dennis probably go first. The next time Benjamin go first. So I wanted it to be open, unless you have other ideas.
Okay, that works.
Yeah, sounds good. I think we just look forward to the session.
Yeah. Thanks, and thanks again for joining and agreeing to be in this session.
Thank you for having us.
Yeah, thanks.
Yeah, just we'll be having on regards to valuation, on regards to companies and their financial performance and so on and so forth. But I think the first one was on regards into valuation. So we do hope that we can have an informative session today. And if you have any question, you can put it down in the chat. In terms of the agenda, we've allocated some agenda items. We'll go through what InVhestia does. We'll go through the speakers will introduce themselves, and then we'll have discussions, and then we'll run down one of our products called Invaluate from our website, and then we'll have a conclusion, any Q&A, and any parting shot from the speakers themselves. So to kick off, I hope everyone can hear me. Jess, hope you can hear me before I kick off.
Yes, Jerry.
Yeah. So great. So InVhestia is well known for its financial model, and the financial model we use a standard called FAST, which is a flexible, appropriate, structured, transparent, recognized by various global institutions, including World Bank. So we basically we started from developing financial models that are easily understandable across different stakeholders. And actually, we look at companies from a sector agnostic perspective. From financial models, we go deeper now to valuation. So from financial models, you can provide several insights from that. Hence now we provide valuation for a particular company from the early stage all the way to mature companies. We've done a lot of assignments on the valuation bit, around 120 up to date, and around 3.6 billion on the estimated value. We also do a lot of capital raising. Once we value, some of the companies might want to raise equity or debt. So we have a relationship with certain investors, global investors and local investors who we reach out to depending on the transaction. So we do the capital raising. We also train a lot of institutions on financial model as a capacity building for various departments. These cross-cuts asset managers, financial institutions, and DFIs. So we've trained around 1,301 participants. We are also known for our Imari competition that happens annually, providing training for students who are on their last year of graduating so that they have a smooth transition into the work environment. As we know, financial model is a key skill that's needed for financial professionals. We also do due diligence. We've done 19 assignments up to date. And I guess the financial model, which stands as our foundations, build around 260 and to continue churning out financial models. Value of companies involved is around 39.8 billion. So that's basically our overview of the services that we offer in InVhestia. So I guess now for this particular session, we will dive into our valuation topic based off our experience that we've had over the years since inception. We will now try, look at, what are the industry experts saying on the valuation from an early stage setup, and what is the ecosystem looking at evaluations. What are the new developments and what are the challenges these particular founders are facing in valuation? We know that valuation is a dynamite issue when it comes, because founders always try to exit at a higher valuation, and also investors. So today we do have Benjamin Barwa. I'll allow the speakers to introduce themselves, and also we have Benjamin Barwa is a project management lead at Villgro Africa. And then we have Dennis Karanu, CFO of FlexPay. So I'll allow you to, we can start with Benjamin. I'll allow you to introduce yourself and a small introduction, and then we can proceed. And also I'll allow Dennis after that to introduce himself. Thank you. Benjamin?
Okay, yeah, thanks, Jerry and the InVhestia team. Yeah, so as mentioned, Benjamin Barwa is my name. I work with Villgro Africa, whereby we support healthcare innovations in Africa, basically through financing and technical assistance support. Yeah, I'm glad to be a part of this timely conversation. Yeah, actually, I believe that us having localized solutions when it comes to this subject matter of valuation is something that we need to embrace at the end of the day. So looking forward to sharing the insights that we've been able to gather over time. Thanks.
Thanks, Benjamin. Dennis?
Yeah, so hi everyone, and thanks Jerry and the InVhestia team for having us. So like it has been said, I am Dennis. I work as the CFO, also a co-founder from FlexPay. So over time we have garnered various experiences, and especially being an African startup, you get to understand that the financial sector is very diverse, and thanks to InVhestia team and others, and for sharing webinars like this, we can get to understand more and also offer insights on how well we can navigate that sector. So I'll get it back to you, Jerry, so that we could start.
Yeah, so we will go as detailed and we'll avoid the technical terms in this particular webinar. So we're assuming that everyone, doesn't know finance or the technical level. And especially for these particular webinars, we try, target everyone across the space, not only the finance people, but also the founders. Some founders are from other sectors. And for that, I would try and maybe Dennis, if you can kick it off because you're a co-founder of FlexPay. How early should a startup begin preparing for a valuation, any valuation? Is it from the inception or after, let's say, 2-3 years, or maybe after 6 months?
Okay, basically, I would say as early as possible, first and foremost. But you would want, first of all, to get at least a product that works. Try to figure out the market positioning, or rather what we call a minimum viable product, something you can present to your customers out there to do. Then now you can start keeping proper financial records for that system as you grow, because we all know that any product must start somewhere and it will iterate and change over time. So as soon as you have the minimum viable product, that's the best time to start on your evaluation journey.
Thanks, Dennis. Benjamin, what's your take as Villgro?
Yeah, so I actually concur with Dennis. Maybe my addition to that is valuation is not like a one-time event. I think what happens in most cases is when most founders want to seek financing is when they think about valuation. But when you look at valuation, is something that we keep on saying that it's ongoing. So as Dennis says, like from that inception phase, once you've been able to have like something you can take to market, having been able to validate that it's a solution that is solving a certain problem, and there's some traction and some impact that is coming out of it. These little bits and pieces that we keep on monitoring or tracking from that initial phase actually play go a long way in terms of handling the valuation bit of it. For example, if you'd look at let's say a founder who is providing an agribusiness solution, at the onset of it, for example, take case in point, you have a technology platform that is providing an agricultural solution. There are things that are tracked from the onset. There could be things like improvement in the yield. There could be things in terms of the number of farmers who are being recruited in the platform. There could be things like how much revenue is being generated from the onset. So all these initial metrics at the end of the day go a long way in terms of building up the valuation at the time that needs to be executed. Yeah.
Okay, thanks. I guess, and I know you say it's an ongoing thing, and I know at Dennis you said at the MVP, and validating a valuation at the MVP sometimes can be very difficult because there's no historicals, and you're basically basing on the forecast. But now, and so these are some of the key challenges that probably these early stage startups or early stage companies face. How can they avoid that particular? How can they validate their particular idea, validate MVP more, even as they try to launch this particular MVP?
Okay. Maybe Benjamin, you start that off.
Benjamin?
Yeah. I'm happy to pick that up. So when we look at that MVP phase, there's a bit of things that are happening which we don't have to overlook, because remember when an innovation, let me use innovation or a solution or a business for lack of a better word, is at that phase. There are a couple of things that we can be able to look at that in one way or another can be able to go towards the valuation of the business. Remember, a number of times what we are familiar to using would probably be either revenue multiples, that initial phase, but then now in this case, this is a business that does not have any revenues that it is generating. So when we sit down and ask ourselves, when we look at the impact that this solution can be able to have, how does it play a part at the end of the day? Let me speak from a point whereby coming from the health sector, with innovations that we get to work with, in some instances, you get to see that there are some telemedicine solutions that are able to provide what do you call this? Maternal health solutions. And you see, at the end of the day, one of the things you could be able to look at, what is like the projected impact of this in terms of the numbers that the rich could be able to have, and see how that gets to play a role. Because the other thing, when you look at it and how it combines with some blended financing approach at the end of the day, we as investors would want to see this will directly translate to revenues at the end of the day. But from the onset, in terms of the market, in terms of the market feedback that is coming, in terms of like the reach that the solution itself could be able to have, what does this look like? And I think another thing, if then you're able to sit down, and I think with this, most of the time we have been taking a global approach, but it's then looking at it from a localized approach. In some instances, we have local solutions that have been able to fundraise. For example, look at a solution like Twigger Foods in the agri space. When you look at them at when they were starting vis-a-vis where they are right now, the evaluation is totally different. But if we get another solution that is having a similar, is addressing like a similar problem at that MVP stage, then we are able to sort of like do a comparison analysis just to be able to understand. 5 years ago, this is what this company was valued. And the fact that then we would want to invest in this solution right now and getting to look at what holistic impact it would have in the long term, what is then realistic valuation we could be able to give it. So that is just some of the simple approaches to look at from that initial phase. And of course, I think for those in the investment space, evaluating some of these early stage businesses is not an easy task. So you have to like get it right from the start. So innovation in terms of the method is then what we try to look at the end of the day.
Thanks, Benjamin. And Benjamin, a few years back, we had, I think 2020, 2021, there's a period of time where, any startup any early stage company could get a lot of funds from, let's say, VCs and all that. What has changed since then? I think, what are the learning and key issues? What has changed since then? From now, what are we seeing now in terms of how these particular institutions value these particular SMEs? What do you think, Dennis?
Okay, and maybe just to add on what Benjamin was saying, and especially talking from experience. So at an early stage, small businesses, it's really difficult to figure out your value. First of all, because you don't have the enough traction to kind of like understand what is the customer lifetime value, for example, at what point will you break even. So, and we should be open, or rather, it's very important for us to be open about the valuation of the company at a very early stage, you'll probably be valued less than at later stage, maybe during Series A. But again, as you grow, you get to change and reevaluate your financial models in order for you to be able to value yourself more. Now on the issue of maybe the learning curves, and especially from during the COVID period, it was really a difficult period for especially small companies and startups to kind of like get investments and all that. But if you look and if you study, what helps is having proper financial records. If you just keep good financial records, it's easy for you to convince maybe a lender or an investor for you to be able to raise capital. Again, you always readjust your expectations. Like, for example, during lockdown, I'm sure there was a slowdown in businesses. So it's always important to reevaluate your position, say that we expected to close the year at this point, but due to X and Y, it was not able to happen. So it's a continuous process, as Benjamin said, and values change over time.
Benjamin, any developments you've seen from the 5 years, from the last few years till now, the valuation?
And maybe just speak to one. I think what we have recognized over the years is there's more appreciation going towards players in this space, and the players in this space, I mean like financial advisors. In the case like what companies like InVhestia are doing, Villgro are doing, just to be able to support innovators or founders to be able to build solid financial models, to come up with like solid valuation data, because it's, on one side, it is one thing to sit down and come up with a financial model, just to be able to back probably like the investment you want to pursue. But then on the other side, it is also important to get guidance, feedback, or insights from players who have been in that space. So that method of previously relying on like gut feelings, one's intuition, seems now to be changing. I think over the years we've seen success stories in terms of a company being able to acknowledge a certain investment company for supporting them to fundraise. And one thing that shows is that there is the increased demand for such services, and also just the recognition of that players who are doing that in that space then are sort of like appreciated, and the support that they give at the end of the day is valued. So that is just what I'll add in regards to what Dennis has said.
Okay, thank you. Thank you for that. And probably to go on the next point is we always hear a lot of investment readiness, investor readiness for these early stage companies across the different sectors. What about valuation readiness? And maybe for Dennis, how have you made sure as a co-founder, how have you made sure that you are always I would say value ready, but the company is ready for any valuation. Yeah.
So maybe just to start off, and I always emphasize on proper financial records. So basically keeping a good record of how you have moved from point X to Y gives a perspective of the value. Also, the other aspects that you need to also account for, maybe like your social impact, also your governance, and those kind of things. And also keeping a proper record of them. So this makes it easy for for when an investor is coming on board, you have a chance to maybe like introduce your product and how much impact it has done. Maybe this is the kind of traction that we have been able to gain on matters revenue, keeping the number of customers. So basically, it's doing that. I'll also emphasize on the aspect of being compliant. Maybe if you are you're in a certain sector that is regulated, maybe the financial sector, maybe you are in medical sector that are regulated, having the proper regulation documents and procedures, having done them, they keep your company at an investment ready position instead of having to now to start that off when you get and then maybe an investor or you want to acquire a loan from a financial institution.
Thanks, Dennis. My question is, does also the team matters when it comes to the evaluation readiness of a company at the initial stage? Because I guess when you look at team, when you're hiring at the startup level, you're just taking anyone who can get the job done. I don't know, Benjamin,
Yes.
Dennis, what's your opinion on that?
Okay, maybe just to chime in before Benjamin. Yeah, so, and I agree, a team is very valuable, and you want to get as much from the early team as much as possible at maybe because small companies access to finances or capital is very limited, but at the same time, you want to be as wide as possible to cover all aspects. So hiring a team, have a good person who can keep financial records, or get someone who is a professional. There are companies out there that offer professional services for accounting, for taxation purposes. So build on that as you move towards being able to afford an in-house team that is well experienced.
Benjamin?
No, I think that's well put by Dennis. The other thing I just wanted to add about is the aspect of scenario planning. And I think this is mostly to do with risk. When undertaking investments in most of these businesses, one of the things we'd want to understand then is their risk exposure. And even if they do understand, so one, what is risk exposure to them, and what are like some of the risks they are facing. So for example, there are those innovations that are in the fintech space and probably don't have visibility of the exposure to maybe forex fluctuations and how that affects them at the end of the day. So just getting to see if they know that, good. If not, then getting to see how that looks like. For those probably in the climate agri space, maybe it might be how do things like drought, lack of rainfall, weather pattern shift affect them, or even just policies that might come up in future. So that's just one of the other things I just wanted to add in terms of that piece to do with valuation readiness.
Okay, thank you very much. And maybe just to go on the participants, if you have any questions regarding the discussions that we are having, please put them in the chat box, and then we will pick them later on once we are concluding or during the conversation. And back to Benjamin and Dennis. I think Dennis mentioned that you will always be valued less. And this is not what founders want to hear. This is not what they expect once they start that particular company with passion. They're passionate at the very start, but this is not what they want to hear. What's the focal point between, in terms of valuation, between the investor and the founder, so that the founder doesn't feel like they're valuing less, and the investor also, gets what they deserve depending on what the money they've put in?
Okay, maybe I think the main reason why most companies are valued less, it's basically over-reliance on historical data. You leave out a lot of value that your company has, because as a founder or a business owner, you have the vision of the company, you understand where you want to go, but what you can only present is the historical data. So you have been ignoring like something like intellectual property, for example. So some of those things should be put well, or rather be considered when you are presenting your case, so that you don't have a case of undervaluation. Albeit it's very hard to defend that that you think your intellectual property is worth this much. Yeah, but I think that's my take.
Benjamin?
Yeah, I think I'd spoken to this earlier. I think for me, what I tend to see a number of times is we have over-reliance on non-local comparables. So, for example, you have, let's say, a health tech solution, which you think this telemedicine platform will be so good for the African context, and then you try to look at it based on another health tech solution similar to that is in probably Europe or the West, and then you use that as a basis to say probably I think my innovation or my solution should be valued probably at a multiple of 10 times, and not taking into consideration we're in different markets, being affected by different macro and micro and macroeconomic factors. So you get to sit down at the table, and when your model is challenged, then you think probably the investor is not having the good interests for you at heart. But of course, we do this taking into consideration that we would want to have it valued through a localized context, because the other issue is to say that, okay, give you a high value, raise more. The next time you go to raise another series of funding, you're then shocked. You're told, no, this is not the valuation of your company. So, as much as we do, I think the most important thing is it's just transparency for all parties. The information that is shared by the investor, the information that is shared by the investee. As long as there's transparency in that process, and just being able to understand this is how we do it, this is why we are doing it, then at the end of the day, we're able to reach that consensus. But yeah, that's my take on the same.
Yeah, thanks for that. I think one of the challenges I picked up is there's a quantitative and the qualitative. Quantitative, based on the numbers, but qualitative when it comes to IP. How do we value the intellectual property of these particular companies, which I believe are the foundation of these early stage companies, and so on and so forth. And I don't know whether there are any other. Do you think there are any mistakes? I will look at it from two perspectives. Are there any mistakes from African founders or entrepreneurs or SMEs when it comes to valuation, other than thinking that they'll always be valued more? Are there any other mistakes that they should look out to once they are going to the table with these particular investors? In the same issue, are there any mistakes that investors oversee on from their end, from those two perspectives?
Yeah, maybe I can go first, and then Dennis, you can jump in. So I'll just add, maybe the other thing is different investors have different expectations. That is one of the key things to also take into consideration. Previously, I've been able to work in a fund that was supporting climate innovations. And one of the things that most investees, in this case, these are the business owners, were struggling to communicate is what is in it for the investor at the end of the day? So you have this good pitch, you have this nicely done model, but in terms of impact, so you find somebody wants to grow a certain acreage of forestry, and then the investor wants to understand, as much as I put my money in this, how will I be able to get a return? So on one side, probably the founder is heavily focused on how probably they would have a structured cycle of growing and felling trees. But on the other side, as the investor, you want to hear where is the story around probably the revenues that can come from maybe, let's say, like carbon credits from that project. And you see, that is a whole different thing, maybe which the founder or the business owner has not thought about, has not even been able to quantify about it. So walking into such, as they walk into such a panel and you start to realize there are such like gaps, then you come to see that appreciation that I was mentioning earlier. The more that founders are able to also engage like professionals in this space, the business models, of course, can always be looked at more innovatively and actually get to see what are other like benefits that come out to this. How can they actually then translate to various funding opportunities that are out there? Yeah, so that alignment to do with the expectation of the investor is another thing that we keep seeing being not sometimes there too out here.
Okay, mine I think would be to echo the same. Mostly it's it goes with the alignment with with your specific investors, and also maybe most I would say investors, or rather most investors would want to understand the customer lifetime value, for example, but you don't keep a track of that. So these mistakes, I think, are some of what SMEs have been making so far.
Great, thanks. Thanks for that. And no one mentioned that we should, as founders or entrepreneurs, we should not overestimate our business worth. So I don't know, in a case where we overestimate the business worth, because everyone does evaluation. There are a lot of templates out there to do evaluation. You put the numbers and you go and value. How can we avoid overestimating? Do we go to as early stage startups? Do we go to a financial advisors? How many are there in the market? And basically, just to avoid overestimating, how do we avoid that or underestimating? Because we can overestimate, we can underestimate. How do we know this is the real value of this particular company at any given stage for an entrepreneur in this case?
Maybe the easiest is always benchmarking with other industry peers. So, and then evaluating your position as compared to that peer. Maybe that gives a better perspective of you understanding the value of your investment, or rather your company, because it will always never be that far from the reality. Now, before you start looking for services from maybe companies that offer valuation services, that might be the start.
Thanks, Dennis. I guess it should come to us. Benjamin?
Yeah, so I think as Dennis puts it, for me, I would just emphasize on so the benchmarking being localized. Like if we get to use the African comparables, the better. That puts us close to a realistic valuation figure that we could work with, so that even as you come to sit to the table, whatever negotiations happen, don't fall far off than probably what one would be expecting. And then maybe the other thing is having like validated data. I think sometimes people might talk about this is my customer base. I think this is a market I can be able to address. But the facts actually go a long way. So if there are claims which could be able to back up some of these numbers, even like some of the outcomes that are being presented, then that puts like more weight on what is being presented for funding. Yeah.
Thanks, Benjamin. I think what I hear resonating a lot from you and Danny is the benchmarking, and there's also looking at the market comparables, but basically benchmarking against your industry peers, very, very important. And for example, if you're in Kenya, I feel like you can also benchmark from other countries in Africa. So looking at Kenya, Lagos, different African countries might have the same idea, and it's good to benchmark. I have a very difficult time. I have 20 minutes left to 12, so there'll be a small transition. As I mentioned in the agenda items, we'll be looking at one of the products that we always we are launching to target the early stage companies, and valuation takes a long time when the traditional approach. We have to look at the historical and all that, and then do a proper model, look at the assumptions, validate the assumptions, and now come up with the valuation. So on our end, I will be sharing my screen in a moment. On our end, we've come up with a valuation tool where it's linked from our website, and allow me to share my screen in a moment, and we'll be taking through for the next 10 minutes, and then after that we can see whether there are Q&As. As we go on, we transition, we can put our questions, the participants, from the discussions that we've had, and then we will jump into those questions if there are any. So just give me a minute. Yeah, so thanks. So the valuation tool is found in our website at the top. It's called the Invalid tool. And then once you click that, so basically the tool is basically for fast tracking the valuation. And sometimes these particular companies, founders are not financially technically able. So what they will be told, let's say in 2 weeks, they need a valuation to be done. In 1 week, they need a valuation to be done. In that case, what do? So we'll always assume now, okay, we wanted to see a way how to fast track to this particular process from the traditional way of how advisory usually do the evaluation, where there is a whole lot of process of information request, and then it takes around 2 months to come up with the evaluation. So basically, when you go to our website at the Invalid tool, you would have the initial interface where we put all the information about what the tool entails, who we target, and what you need to fill in the particular tool so that a valuation is done at the end. I guess I've said why we choose it is time efficient. It's African focused, based on we try look as much as possible. I know there's a challenge of getting information based on precedent transactions, but we try look at African transactions. But in any case, if we don't find, we go to the developing markets similar to Africa. But I guess we stick to the African focused comparables. Different packages, we provide different packages. This is less because now we provide, it's already automated, and those are the different packages. For the basic packages, turnaround is around 2 days, and then for the standard package, turnaround is 4 days. You can visit our website if you want to go and look through it. So in any case, if someone takes the standard package, in this case, there will be a lot of some information that we will require from you as a company. Basically, the company profile, what the company does, a link to your website, and and how many countries you are. Sometimes the valuation involves a lot, depending on the size of the particular company, the number of operations the company does, and so on and so forth. How many subsidiaries that the company has, how many revenue line items that the company have. So those are the things that we'll be looking at in this particular section on company information. So I'll just fill some sections here so that we can proceed to the next. So we tried to limit it to be not so much information, and so that we can be able to extract a valuation in a quick turnaround. In addition, we also, some of the questions that I hear is to provide some of the reasons for valuation. Sometimes it can be due to strategic planning, it can be due to dilution if a company is trying to capital raise, and so on and so forth, even sometimes litigation purposes, and also mergers and acquisitions. So depending on where the company is, why they want to do the valuation, I think it's important for us to know that. On our guidelines, this is basically to provide assurance that we are going to keep your data safe. On the financial overview, as we've mentioned, that the valuation really sometimes is it's the foundation of it is the historical bits and the numbers bits when you come into the quantitative. So we really need the financials of the company. Based on the company will be able to feel the financial. I guess the financial manager, the founder, if they have the financials ready, they'll be able to feel. So we're given two options in this case. We have the first option where you'll downloadable link will be is when you click it, it will be able to take you to an Excel where you'll be able to fill the particular information based on your historicals and year to date. And then on the second part, there is where you can be able to fill online, and then we can be able to receive that particular information on the back end. So once you go on the clickable one, which is the first option, we've given several key line items, which for early stage companies would be, this information will be available. So we've not gone granular into detail as a traditional way. We've basically given an overview of the key line items the startups would have. As again, we've discussed that the key things in being valuation ready is having the management records, the financial records in place. So after that, you'll be able to download an Excel sheet. Then so the Excel sheet can be done either offline or online, depending on the company or depending on the person filling the particular sheet. Once you have filled all the information that you want, you will upload the file, and then you'll notice that the second option will collapse. So that means that you've used the first option. In addition, we look at some figures on the forecast. I think it's important for us to just have that information. I guess there'll always be a forecast in this particular information. I guess it's subjective, but it's important for us to have. If the company you forecast on the EBITDA side that is going to increase by 20%, I think you can feel that there. And then on the gross margin, give us by how much. And then I'm just taking numbers off my head. Have you conducted a previous valuation? It's always good to compare the previous valuation and the one that we will currently do. And then do you have a preferred valuation? If yes, you pick the preferred valuation that you think is good for your company. So different on the financial services, I think we only see a different valuation method compared to the others companies in the other sectors. On the risk factors, we are looking at, it's good to just understand if you have any competitors in place. And in this case, you just fill up the risk aspect and the market share. If you know the market share, it's important for us to know. I think there will always be, for this early stage startup, there will always be a bit of market share. And these are some of the questions that the investors will always come with. What's the market share of their company, and so on and so forth. Any products and services the company wants to launch in the next few years. Here we try look at is the company doing a lot of research and development, and what's the future, the focus of the company. So some of these things, it's good to have it outside there so that we be able to also in the revenue side, we'll see, okay, if there are new products into the company being introduced to the company, what will be the new revenue over the forecasted period. How much does the company invest in R&D in the next innovation annually? I think it's important to just have that in place. After that, we will proceed. We will proceed now where we will get your contact information on that, and then we will now proceed now to the next steps and probably share with you, depending on the package that you have, share with you an invoice, and then we generate the particular valuation report. So you leave your number and you leave your valuation, you leave your email address, and we will get that information on the back end. So that's it on our Evaluate, basically to assist, basically to have a quick turnaround for the early stage companies, for the startups, and basically anyone who wants to generate valuation, have a quick turnaround and time efficient valuation. And after that, we'll have a valuation report showing your valuation of your company, and then we'll have a discussions on that. Thank you very much. I think I'll now go to our chat box if there are any questions regarding our discussions that we've had today. I think Benjamin, you mentioned there's one question from Philip Gituku. You mentioned the need to use localized peers or comparables in the valuation process. How do you identify and access these comparables, given that a lot of them are startups and their financial operating metrics are usually kept private? Benjamin, or even Dennis, you can join in.
Okay, maybe because the question is for Benjamin, he can start off, but I'll add a few.
Okay. Yeah. So maybe I'll speak to three things. So one is to do with so in the space that we are in, of course, we get to speak and just to be able to know who is fundraising at the moment, what amount are they fundraising for, what does their valuation look like. So in the space, and I think one of the things I would recommend, if you have the opportunity to engage with accelerator programs, investment programs, or even some of the investors in the space that might not be from the development space, there is information that they could be able to share, which can, in one way or another, help you. Because even at the end of the day, when we go about doing these evaluations, when I talk about like being able to localize it, it's also being able to understand what other founders have raised in the space, from who, and how they went about it. So as much as it is then private and confidential, we are able to discuss and just see how it is able to help us also in the evaluations we are conducting for our respective founders who are fundraising. The other thing is to do with reports that are usually released. So the couple organizations, be it World Bank, be it IFC, be it IDRC. These are international organizations which you'd find over time they're able to release sort of like ecosystem reports based on like funds that are being raised in specific sectors, in specific regions, and the type of businesses that have been funded and the size of the businesses that have been funded. So again, from this, we're able to get some insights then, which we get to use at the end of the day. As I'd talked about not being able to rely on sometimes the global benchmarks. The innovative approach you could take about that is because we're in a different market is to see how to discount that valuation you have done at the end of the day, so that if you're looking at a similar company that is fundraising and probably you want to use a multiple of let's say 8 to 10. Why then not about based on the current like market we are in, scale it down, and probably you might go between 5, 4, something like that. And again, being able just to sit down with investment and fundraising experts just to validate then this now goes a long way to just shape the valuation to what would be expecting at the end of the day. But I'm sure also Dennis might have some other insights to add. I will let him jump in.
So maybe just to answer that question in a different way, most investors or other founders who are looking to invest approach this like they are doing it as an espionage. Like you want to study a certain company. If you reach out to them and maybe request for a sit down, maybe like their financial officer, they can be able to give out maybe a few data that they feel will help you, because at the end of the day, it's more of a collaborative approach more than like you are trying to figure out what are they doing. All the same, there are reports that, like Benjamin has said, there are reports that are done out there, and it's very important to maybe do a good research. Things like Crunchbase, Deal Room, they always give a perspective of where the industry is at, and so you can be able to benchmark from that. So yes, but most of the things Benjamin has already touched on them.
Thank you, Dennis. Thank you, Benjamin, for that. I think, Philip, I think that question has been answered intensively. And I don't know whether there are any questions from the discussions, any questions from our products that we've just shared. And maybe to re-emphasize that, based off these discussions, what we are seeing is, the African focused valuation. So we always need to use the market comparables in Africa before even going outside Kenya. So you can always, for those startups that are looking to value at a very at a time efficient and a quick turnaround. Importantly, a quick turnaround, because some of these founders never, when they want evaluation, they want it now. So they want the valuation now. So basically, it's good also as a early stage company, even as you're growing, look at some of these particular products as the one that we put forward, evaluate. And yeah, thanks, Philip. Well answered. Thank you. Thanks, Philip, for that. Any other question? Any other comments on our products? Any other comments on the discussions? Both to Philip and Benjamin. I guess silence means that it was a very informative discussions that we had today, and I was going to allow anyone, even if they want to unmute, but in any case, this is a series of info sessions that we'll have on basically the valuation, and probably the next time we can have even for mature companies. But for now, I just want to thank Dennis and Benjamin. I know it's 12:02, so Dennis and Benjamin, you can have any parting shot from this particular discussion, even as we end it. Thank you.
Okay, so first of all, thank you for the InVhestia team for preparing something like this. So because it's very important for founders out there to have access to information, because most of us suffer for lack of knowledge. And when you get to engage with people of similar backgrounds or other outlook, you get to understand more on how to move around. And also for also providing invaluable resources for founders to be able to plug in their startups, and they can easily get valuation reports and something of that might be helpful to build them. Yes, so that would be my parting shot. Thank you.
Thanks, Dennis. Benjamin?
Yeah, thanks to the InVhestia team for this. Actually, this is a very timely solution. I know how the whole valuation process is actually quite intensive. And I think if we are getting to a point whereby we can automate this process and make it easier for the founders, that is quite innovative. So I think for me, the thing is just then I think it's now that's the call to action for innovators to be able to explore the solution itself and make use of it, because valuation is actually a very key activity to be done at the end of the day. A number of times we get to hear innovators want to fundraise, but they don't know what the value of their business is. But thanks for having me on this platform.
Yeah, thanks, Benjamin. Thanks, Dennis. As our financial advisors, we all on the other side, we want the founders, to get a huge a partial liquidity, and on this other side of investors, we want them to get value for money. So we are at a difficult point. So thank you for that. Thank you for this particular discussion, and thank you for your time and making yourself available. And also for the participants, this will be an ongoing discussion. So look out for the next webinar. Thank you very much. Thank you. Thank you so much.